So, welcome back to another episode of Retirement Income Planning with Eric. So, previously we talked about the effect of savings, the base case, the minimum amounts you need to retire if you walked into a bank, how to use this calculator, what it is used for, and how to get it. So, if you haven't gotten this calculator, then you can go to the link 5minuteinvesting.com/retirement-return-calculator. Enter your email here and I'll send you the copy of this calculator, and then you just click file, make a copy, so then you can make this your own and play with it. Okay, so by now hopefully you watched the previous episodes and you actually know the effect of savings, how this entire calculator works. So now we're going to talk about being aggressive. And when you think about the reasons for being aggressive, it's really for a faster retirement. It can be for a secondary income source, or you're simply just not happy with the return you're getting from your financial advisor, whether that is 5% or 7%, so you want to invest in something riskier. I know quite a few people. Some people will do this because they want to have more fun. Some people will invest in crypto because they think they'll get a higher return. Some people do this through penny stocks. Some people do this through options. And in my case, my target is 30% return a year, and my strategy is called long-term options. So far, that's the strategy, and I've been able to hit this target for the last 5 years or so. So when you're planning for your retirement, how much should you dedicate to a more aggressive strategy? So when you're looking at the current return, it might be, hey, you're making 7% a year, and now you want to make a higher return, like 30% return a year. And you might start out with 100K, and here, if you enter 100K, then all the numbers below will get updated as well. So that is pretty straightforward. So this is an all or nothing situation, but this is actually not how I use the calculator normally. Now, in the past, it's very easy to create this situation where, you put 100,000 in a mutual fund versus you put 100,000 in an aggressive strategy like investing accelerator. But over the years, I've come to the realization that you want to have a mix. And this can be, various reasons. You want to lower your risk. You don't know whether the strategy will work out or not, or you just want to have less volatility in your portfolio. Because when you're looking at a strategy that has a higher return, this usually means your portfolio dollar value will also fluctuate more, whether that is up or down, because obviously nobody can predict the market. So what's important is the annual average return you get, but sometimes people will get very emotional because the portfolio swing 5 to 10% plus or minus. So that's really something you need to consider, even though you can't exactly demonstrate it in the model using this calculator, but that's what you got to keep in mind. So for this scenario, I'm going to talk to you about a story from my subscriber, and she had actually $500,000. So she's the subscriber that had $500,000, and the financial advisor told her you cannot retire. So she was getting something like this: 5% return, monthly savings. I'm going to lower that to around $500. And then afterwards, her balance is $500,000. So she wouldn't be able to retire in 15 years and reach $2 million. So that's why she reached out to me. Now, in this case, well, it's very easy to say, hey, Eric, why don't you just put all the money in the investing accelerator strategy? But you need to think about, well, is this person going to be comfortable doing that? And if not, what is a good amount that allow you to reach your goal without putting in a lot in an aggressive strategy? So I think this is really a balance of how much you're willing to risk versus what do you need to do in order to get to retirement. So for her, this is what we came up with. So majority of it are still in kind of low volatility, safe index funds. So that is just basically what she's doing right now. And my estimate was that she was getting a 5% return. And then she would put in around 100,000 using investing accelerator strategy. So this is around what, 20% of the portfolio? So it's quite an acceptable amount. And here you will see that I actually put $0 into monthly savings. Now this is quite important. Obviously I can allocate this over, but in this case, let's just say she stick with her monthly savings in her regular account. So then we just leave 100,000 not touched and let it grow using the strategy of investing accelerator and target 30% return. So what you'll then get is that after 10 years, you will approximately 10 times. Okay, so these two numbers combined together allow her to get to $2 million. Now, of course, you will need to be more conservative, meaning that you need to think about sometimes you might not get 30% return in some of the years. So then within 15 years, there should be enough buffer room for the subscriber to get to $2 million. So I think if she even get around 70% of the years getting 30% for this 100,000, that will already get her to the finish line, maybe even earlier. Now, one of the questions that I get a lot for those who didn't attend the free training in the description is whether 30% is reasonable. And this is actually a very good question, because initially, I think around 6, 7, maybe 8 years ago, I actually thought 30% is not reasonable. But once you get to meet a few more fund managers, then you'll realize 30% is actually a target they aim for. So I'm not talking about mutual fund managers. I'm actually talking about private equity fund managers or venture capitalists. So these are the people where they're investing in startups. They're investing in large private companies that are growing very rapidly, that one day they might go IPO. And they will use debt to invest in those companies. So when you take into the accounts of leverage, you take into the accounts of startups, what they aim for is actually 10 times. So it's called 10x in the startup world. And well, the question is, how many years does it take for you to 10x? So in this case, one of my friend who is in the venture capital fundraising industry, he told me that, well, I would aim for 10x in 10 years. And that will actually work out to 30% return. So here you can see that is the proof of my friend's calculation. So where you get 100,000, you invest it for 10 years, and you'll get to $1 million. And right now, you can see this calculation can seem a little bit unrealistic, but in terms of achieving 1,000% return, I have already done that pretty much in the last 5 to 6 years. So it is quite achievable if you know how to do it, of course. And when I was talking to my friend, he actually handles money for really wealthy investors. So we're talking about people with millions to tens of millions to invest. So if that is the scale wealthy investors are playing at, and if this is the return they're aiming for, then I think regular individuals like me and you, where we're investing our salary, where we're trying to retire earlier, should be able to achieve this kind of return as well. So even if you're not using a strategy like investing accelerator, or you might be day trading or investing in startups because you are an angel investor or whatnot, I think 30% return is quite achievable. And if you have ever ran a business, or if you have ever ran like an e-commerce company or like a digital marketing company, then you will realize that 30% return is actually not that high, because every dollar you put into a business, you might get $2 back. And if you are able to put $1 into a business and get $2 back, that is 100% return within a year. So you can see why so many people are looking to be business owners, because sometimes you're able to get a higher return. Now, of course, the risk and reward for being a business owner versus investing in the stock market is different. Some people will say being a business owner is riskier or less risky, but that's just a debate for now. So if you are able to visualize and understand that 30% is reasonable, then what's important is a matter of allocation. So for that individual or that subscriber who hopped on a call with me, this is what we agreed to be reasonable. And I think it is quite achievable. And now she has a clear path to retirement. So the question now is, well, if you're just starting out, or if you have, let's say, 200K, it is possible to be less aggressive or more aggressive, depending on how you see it, is to put half-half. So half in index funds or half in a more aggressive strategy, like getting 30% a year. Now, when you're looking at this calculator, I don't want you to think that it is limited to stock investing, because I know some successful real estate investors, they can make 30% per year. And I'm talking about tough markets like Vancouver, where the cap rate is really low, and by using leverage, they're able to get 30%. I know some house flippers in the US, they're able to get 30% to 100% return within a year. So when you think about that, the question is, well, how much do you want to allocate? Now, if you are really aggressive, then yes, you can just put 0 here, and dedicate everything into this 30% return per year strategy. So that's actually what I do. I put all of my money into one single strategy. I don't have any index funds. And I know that if someone is in real estate house flipping, they probably don't have an index fund portfolio until a lot later, and they will focus on buying rental properties, renovating it, renting it out. So that's actually another individual I met where he had 3 properties just 5 years ago, and he's kind of like a home improvement person, and he put his entire portfolio there, and now he's looking to diversify. So it can be really lucrative depending on your expertise. So what's important is to look at what you're good at and maximize that return. But if you don't know what your return is, then you can't really maximize it. So that's why it's so important to know what your return is. So we're just hitting the 12-minute mark. So in the next video, we're going to talk about the withdrawal rate and how much each person needs to retire. So we'll see you in the next video. And of course, if you're interested in learning more about investing, then you can go to the link in the description below. And it is a 4-hour training on how to invest in the stock market, or how I invest in the stock market. And I'm sure you'll learn a lot from that free training. And afterwards, if you're interested in Investing Accelerator, then you can schedule a call with me. I'll see you in the next episode.